Does getting married combine your credit scores? No, but rushing into a joint mortgage triggers a lower of the middle penalty that turns one spouse's past into a shared nightmare. Couples assume getting married automatically merges their financial identities. You sign the marriage license, combine your checking accounts, and figure your credit files blend into one household profile. They do not. FICO does not care about your wedding ring, and the credit bureaus do not issue joint credit reports. But the moment you start applying for massive loans together, the invisible gap between your two scores becomes a very expensive problem. In the next few minutes, we will unpack exactly what changes, what does not, and how lenders actually price you as a couple. This is Optimized Credit, where we teach how credit actually works. Start with the foundation. You were born with one social security number, and you die with one. The three major credit bureaus, Experian, Equifax, and TransUnion, track consumer data strictly at the individual level. There is no such thing as a joint FICO score. There is no married couple file. You and your spouse maintain separate, distinct credit files for your entire lives, regardless of how long the marriage lasts. The confusion happens because marriage changes the financial architecture around your files. You start opening joint accounts. You apply for shared auto loans. You become co-borrowers on a house. The accounts are joint, but the reporting remains individual. When a joint credit card updates its balance, that exact same balance and payment history is copied and pasted onto your individual credit report and onto your spouse's individual credit report. This brings us to the mortgage trap. Buying a house is where married couples realize exactly how FICO treats their separate files. If you want a conventional mortgage and you need both incomes to pass the lender's debt-to-income ratio, you have to file a joint application. The underwriter pulls a tri-merge credit report. That means they pull FICO scores from all three bureaus for you and all three bureaus for your spouse. First, they throw out the highest and lowest score for each person. That leaves the middle score. If you have scores of 790, 780, and 760, your middle score is 780. If your spouse has scores of 640, 620, and 610, their middle score is 620.
Then comes the brutal part. For conventional pricing, Fannie Mae and Freddie Mac tell the lender to look at the two middle scores, the 780 and the 620, and use the lowest one. The 620 becomes the qualifying score for the entire mortgage. That weaker score dictates the interest rate, the private mortgage insurance premiums, and the ultimate approval. Your 780 and your spouse's 620 do not average to a friendly 700. The lender prices the loan as if both of you were a 620. On a $400,000 mortgage, the gap between a 620 and a 780 borrower costs tens of thousands of dollars in extra interest over the life of the loan. The wedding did not cost you that. Applying jointly with a weaker file did. Which leads to the question every newly married couple needs to ask before they sign anything. Do we both need to be on the loan? If the higher score spouse can qualify on their income alone, you have a real option. Apply with one borrower, the 780, and skip the lower file entirely. You lose the second income for debt-to-income ratio purposes, but you gain the better interest rate. Run both scenarios. Sometimes one borrower with great credit beats two borrowers with mixed credit. Sometimes the dual income wins anyway. The point is you choose. The point is you do not accidentally get priced off the weaker file because nobody told you that is how the system works. To prevent the mortgage trap, you have to close the gap between your FICO scores before you apply. The fastest mechanism to do this is authorized user piggybacking. If your spouse has a thin credit file or a lower score, you can add them as an authorized user to your oldest, cleanest credit card. When you do this, the credit card issuer will report the entire history of that account directly onto your spouse's credit report. The age, the payment history, the limit, all of it. If you have had the card for 8 years with perfect payments and a utilization rate under 9%, FICO will suddenly inject 8 years of flawless data into your spouse's scoring algorithm. For a thin file, this is the single fastest legal credit boost available, acting as an artificial gravity that pulls their score up. But here is the catch most people miss. The authorized user relationship is a one-way mirror. FICO 8 penalizes authorized users for bad data. If you add your spouse to a card and then you run the balance up to 90% of the limit, both of your FICO scores will drop the same week. The authorized user absorbs the exact mathematical weight of the primary cardholder's behavior. Pick the right account and it's free points. Pick the wrong account and you just damage the spouse you were trying to help. If an authorized user account is causing active damage, you do not have to live with it. Call the bank, remove yourself as an authorized user, and file a dispute with the bureaus to delete the trade line entirely. Because you have no financial liability for the debt, the bureaus will wipe it from your file and your score will reset.
If you want a free, personalized 30-day action plan built from your actual credit report, head to optimizecredit.net. Another invisible threat to a Newlyweds credit profile is the name change. This is the one almost everyone overthinks. FICO does not receive government alerts when you change your last name. The Social Security Administration does not talk to Equifax. Updating your last name with the government does nothing to your score. The credit bureaus only learn about your new name when your existing creditors report your next monthly statement with the new name attached to your old account number. When the bureau's system sees the same Social Security number, the same address, and the same account number, it updates the personal identification block on your file. Your account history is keyed to your SSN, not your name. The new name appears as an additional name, the old name stays in your history, and the score does not move a single point. The danger here is a split file. If you change your name with one bank but leave your maiden name on another credit card and move to a new apartment at the same time, the bureau's matching algorithm can fracture. It assumes you are two different people. Your single credit history breaks into two incomplete reports, neither of which has enough data to generate a strong FICO score. To prevent this, update your name systematically. Change it with the government first, then update every single open credit account you have in the exact same week. Pull all 3 reports 6 months later and confirm the new name is showing on each one. Legal liability also shifts depending on where you live. 9 U.S. states operate under community property law, including places like California, Texas, and Washington. In these states, debts incurred during the marriage are legally shared, even if the credit report only shows one borrower. If your spouse goes out and gets a personal loan in their name only, that loan will not appear on your credit report. Your FICO score will not drop. But because you live in a community property state, the creditor views that debt as a shared marital obligation. If the loan defaults, the bank cannot ruin your FICO score, but they can come after joint assets to satisfy the judgment. Credit reporting and legal liability are two entirely separate systems. FICO measures data. The courts measure responsibility. The bureaus will not tell you what your spouse is opening. The court will. This distinction becomes catastrophic during a divorce. Couples routinely rely on a divorce decree to settle their joint debts. The judge orders one spouse to pay off the joint credit card and orders the other to pay the joint auto loan. You assume you are in the clear regarding the credit card. 6 months later, your ex misses 3 payments on that joint card. Suddenly, your FICO score plummets by 80 points. You call the bank, waiving the divorce decree, explaining that a judge ordered your ex to pay the bill. The bank does not care. FICO does not care. A family court decree binds you and your ex-spouse. It does not bind the bank. The original contract you signed when you opened the joint account supersedes the divorce decree. Until that joint debt is paid off, closed, or completely refinanced into one person's name, you are legally liable for the balance, and FICO will punish you for any missed payments. The same logic runs in reverse for debts your spouse brought into the marriage. If your spouse had $40,000 in credit card debt before the wedding, that debt stays on their file alone, in their name alone, with no liability to you, in every state. A prenup can clarify how debts taken on during the marriage get categorized, but it does not bind creditors either. Creditors only respect the original signature on the original contract. The decree is paperwork. The contract is law. Marriage does not merge your credit.
It merges your exposure. Every joint account, authorized user link, and community property purchase is a place where one spouse's behavior now writes on the other spouse's file. Pick those moments deliberately, run the numbers before you apply jointly, and check both files before you sign anything with the word "we" on it. Understanding these foundational rules is only step one. To map out your exact next moves, run a free profile scan and get your 30-day action plan at optimizecredit.net. And make sure to subscribe for more step-by-step credit education.